Today, we will talk about understanding depreciation recapture. Depreciation recapture is the gain realized by the sale of depreciable capital property that must be reported as ordinary income for tax purposes. This occurs when the sale price of an asset exceeds the tax basis or adjusted cost basis, and the difference between these figures is recaptured by reporting it as ordinary income. Companies account for wear and tear on property, plant, and equipment through depreciation. The IRS publishes specific depreciation schedules for different classes of assets, which tell taxpayers what percentage of an asset's value may be deducted each year and the number of years for which the deductions may be taken. Annual depreciation expense lowers the ordinary income that a company or individual pays each year and reduces the adjusted cost basis of the asset. Any gain from the disposal of a depreciated asset must be reported and taxed as ordinary income, rather than the more favorable capital gains tax rate. The first step in evaluating depreciation recapture is to determine the cost basis of the asset, which is the original cost basis minus any allowed or allowable depreciation expense incurred. For example, if business equipment was purchased for $10,000 and had a depreciation expense of $2,000 per year, its adjusted cost basis after 4 years would be $10,000, equals $2,000. The realized gain from an asset sale must be compared with the accumulated depreciation. The smaller of the two figures is considered to be the depreciation recapture, which will be treated as ordinary income when taxes are filed for the year. Depreciation recapture on real estate property is not taxed at the ordinary income rate as long as straight-line depreciation was used over the life of the property. Any accelerated depreciation taken is still taxed at the ordinary income tax rate during recapture. The unrecaptured Section 1250 tax rate is currently capped at 25%. For example, consider a rental property that was purchased for $275,000 and has an annual depreciation of $10,000. The realized gain on the sale will be compared to the accumulated depreciation to calculate the depreciation recapture amount. Depreciation recapture is calculated by subtracting the adjusted cost basis from the sale price of the asset. The adjusted cost basis is the original price paid to acquire the asset minus any allowed or allowable depreciation expense incurred. If, for example, the adjusted cost basis is $2,000 and the asset is sold for $3,000, there is a gain of $1,000 to be taxed. Depreciation recapture is treated as ordinary income and taxed as such. With real estate, the gain beyond the original cost basis is taxed as a capital gain, whereas the part that is related to depreciation is taxed at the unrecaptured gain Section 1250 tax rate, which is capped at 25%. Depreciation recapture can be quite costly when selling something like real estate. Other than selling the property for less, ways around it could include using the IRS Section 121 exclusion or passing the property to your heirs. If you find yourself in this position, speak to an expert before acting. Depreciation recapture offers the IRS a way to collect taxes on the profitable sale of an asset that a taxpayer used to offset taxable income. While owning the asset, the taxpayer is permitted each year to expense its declining value to reduce the amount of income tax owed. However, if that asset is later sold, the IRS may be able to claw some of that money back. Depreciation recapture is calculated by subtracting the adjusted cost basis, which is the price paid for the asset minus any allowed or allowable depreciation expense incurred, from the sale price. It only applies when an asset is sold for more than its adjusted cost basis and is taxed differently depending on the type of asset. Here are 4 key takeaways. 1. Depreciation recapture is a tax provision that allows the IRS to collect taxes on any profitable sale of an asset that the taxpayer had used to previously offset taxable income. 2. Depreciation recapture on non-real estate property is taxed at the taxpayer's ordinary income tax rate, rather than the more favorable capital gains tax rate. 3. Depreciation recaptures on gains specific to real estate property are capped at a maximum of 25%. 4. To calculate the amount of depreciation recapture, the adjusted cost basis of the asset must be compared to the sale price of the asset. Hope this would help. Thanks for watching.